Alright, in this video I'm going to talk about IRA contributions and your annual allowable contributions, whether it's a traditional IRA or a Roth IRA. And sorry that my camera seems to have stopped working, so I'm just going to have to record on the screen, which is better probably for this one because we have a worksheet to talk about as well. So I'm on page 19 in your textbook, and for traditional or Roth, your annual contribution your annual allowable contribution is $5,500 unless you're over age 50. Then they add an extra $1,000. It's called a catch-up provision for not doing it when you were younger. So they let you contribute up to $6,500. That's for you and your spouse. So even if your spouse isn't working, you can contribute $5,500 into his or her IRA, or if you're over 50, then $6,500 into to the IRA. The only one that has a deduction is the traditional IRA. So these are the rules. A traditional IRA is you're allowed a deduction for it, meaning that it's not taxed, and it's an above the line deduction. So let me go down. I need to arrow down just a little bit down here. Line 32, IRA deduction. It's deducted from your total income to get your AGI. That's kind of a good thing. We're going to see reasons why that's a good thing when we get to chapter 5. So you get a deduction for your traditional IRA up to $5,500, or if it's a Roth IRA, let me back up. So you get your deduction. Then when you take the money out upon retirement, it's going to be taxed. However, usually when you retire, your income is way lower, so you're most likely be in a lower tax rate. So you get a tax deduction when you're at a higher tax rate and pay lower taxes when you're at the lower tax rate. There's also a Roth IRA, and Roth IRAs, you don't get a deduction for those, but the money is not taxable when you take it out. So you can earn, if you had a Roth and you contributed to that for years and years and years, and you had earned a ton of money in your Roth because it was invested well, none of it would be taxable. That's kind of cool. Now there are rules, though, lots of rules about this. The first one has to do with how much you can contribute. So let's look at Roth IRAs first of all. So even though you don't get a deduction, you are limited as to what you can put in, and we said $5,500 or $6,500 depending on your age. However, if your income reaches the threshold limit, then you're going to be limited and potentially phased out. So the chart at the bottom of page 19 is your Roth phase outs. So if you're single or head of household, when your income reaches the 118 to 133 range, you're going to be phased out. Once it exceeds the 133 range, you can't contribute to a Roth IRA at all. And then if you're married filing jointly, it's 186 to 196. So 186,000 to 196,000. Between that range, you're going to be phased out. Above that range, you can't contribute. Below that range, you can contribute the full amount. There's a little note. It says active plan participant status is not relevant. We're going to talk about that in a minute. They're just saying it's not relevant here, but we'll see what that means when we get to the traditional IRAs when we turn the page. So let's turn the page to page 20. This is AGI phase-out ranges for traditional IRAs. There's a lot more to this one. If you're single, head of household, and you're not a plan participant, that means you do not participate in any kind of retirement plan through your work, whether it's a 401k, a 403b, whatever that happens to be. You don't participate in anything. You don't have such a thing. So there is no phase-out range. You can make $2 million a year. If you don't participate in one of those plans, then you can contribute the full $5,500 or $6,500. Now, keep in mind, we're going to talk about this later, but those plans usually let you contribute way more than an IRA does. So it's usually better to be a plan participant. But you never know. So if you're a single head of household and you are an active plan participant, then this phase-out range is $62,000 to $72,000. So that's a bit different phase-out ranges quite a bit lower than the Roth. If you're married filing jointly and you're both active plan participants, then when your phase-out range is between 99 and 119,000, and that's for your total AGI, then you're gonna be phased out. If neither of you is an active plan participant, there is no phase-out. Where it gets kind of weird is when one of you is an active plan participant. So if one is an active plan participant, we have to look at each of them individually. For the active plan participant, we're still going to look at total AGI. So you're going to add the AGI together for both people. But the person who participates in some sort of plan through work, that when that AGI reaches $99,000 to $119,000, that's the phase-out range. The person who is not an active plan participant, they don't have anything at work, the phase-out range for their total AGI for their joint AGI is 186 to 196. I think the best way to look at this is through a couple of examples. And so let's look at, I'm looking at page 20. Ed is 31 years old, is single, and is covered by a retirement plan. So he's an active plan participant. If his modified adjusted gross income is $66,000, the maximum deduction for traditional, he's going to be phased out, isn't he? This phase-out range works. The phase-out works the same way as it has in the past. So let's look at that. It says that he's going to be limited to $3,300. Let's figure out how he got that. So the range is 62 to 72,000. So we're going to take the top end of the range, 72,000, minus the amount of money he made, 66,000. So that's $6,000. We're going to divide by the range. 62 to 72 is 10. That's $10,000. So we're going to divide by $10,000. So 6,000 divided by 10,000, and then multiply that by the $5,500 that he wanted to contribute. That gets us $3,300. That's what's allowed. So it's not the phase out, but that's what's allowed. So there's it shows you the formula really well right after that example, kind of in the middle of that example. So Ed may choose to contribute $5,500 maximum to his traditional IRA, but the remaining $2,200 would not be deductible. Alternatively, he may contribute the remaining $2,200 to his Roth IRA since his income is below the Roth threshold. So that's kind of cool. Contribute his maximum to his traditional of $3,300, and then the difference go into a Roth. He could also choose to ignore the allowable contribution, contribute his full $5,500 to a Roth. So he could also put the whole thing in a Roth. So I hope that makes sense. If it doesn't, please stop the video and read through that example again. I'm going to move on to the next example. Anne, who is 36, is single, would like to contribute $5,500 to her Roth. Okay, however, her AGI is $121,000. While she's single, 118 to 133, that's a $15,000 range right there. So she's in the range. So we're going to take the top end of the range, 133, minus what she made, 121,000, divided by the range of 15,000, then multiply that by the $5,500 that she wants to contribute. That gives her $4,400. She's allowed to contribute $4,400 to the Roth. Let's see here. If she were 56, then she'd be allowed the $6,500. So you'd multiply that formula times $6,500, and then she'd be allowed $5,200. The last one, this is where it gets a little bit tricky, because this is going to have some married traditional IRAs with one an active plan, one not an active plan participant. Paul and Lucy are married and are both 36 years old. Lucy is covered by a retirement plan and earns $62,000. Paul is not covered by a retirement plan and earns $58,000. All right, so let's add up what they have. $58,000 plus $62,000 is certainly going to be over $119,000. Looks like it's $120,000, doesn't it? So, or is it? I don't even know. It's what's the phase out range? 186 to 196. Yes. Since their income is greater than $119,000, which is the top end of the phase-out range for married couples, for the active plan participant, then the active plan participant cannot participate. Paul, however, can make a full deduction of his $5,500 because the range is 186 to 196, and they don't fall into that. They're well below that. Lucy could still contribute, make a $5,500 contribution to a Roth because the Roth joint AGI is 186 to 196. So they're not above that. So the one who couldn't participate with a traditional could participate with a Roth. And Paul could make his contribution to a traditional or to a Roth. It doesn't really matter. If he makes it to a traditional, he gets a deduction now, which sometimes that's what we want if we want to lower our tax liability. I think that's all I'm going to talk about for now. We're going to continue the next video with Roth and traditional.